Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
All right, welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham. I'm here with Ethan Hutchison and Eric Wymore, co-hosts of the podcast. How you guys doing today?
Pretty good. Doing very well, thanks.
Good. I guess it's Thursday here, mid-March when we're recording this, and obviously it's been a pretty turbulent time in the markets. Last couple of weeks, we've been talking about it. We've seen some ups and downs, and I know this is something for all of us we've been through before, right?
Yeah, absolutely. I think, we've talked about, things that we've had more conversations with clients. It's always about some kind of market volatility, a market downturn type of stuff and what's going to go on with the market. So this is nothing new to us.
That's right.
The conversations have shifted from talking about the weather to the markets.
That's right. I mean, it's basically been kind of boring the last couple of years, right? Because markets have just kind of gone up. And so review meetings are a little bit easier and people have a little bit less fear. But, we always say as financial advisors is that, we have kind of two jobs, one of which is to be a financial advisor and one of them is to be a little bit of a psychologist, right? Or a psychiatrist when markets are volatile and people are feeling fear and experiencing different emotions about their money. And I think this is one of those times that people are starting to do it. And the reality is the market really isn't down very much relative to where it has been in other times in the past. Like I think from the recent high as of today, the S&P 500 is down about 10%, which is just kind of a normal correction. However, I think it's because of the news and the headlines and how fast it's happened that it feels a little bit more drastic probably for some people. But, so one of the things we thought would be great to have a podcast about is just about the psychology of investing and things that people can do during down markets to kind of just keep themselves on track and keep their mind moving in the right direction. And so, there's something that was put out called the Wall Street cheat sheet. It was actually in Time Magazine. And we're going to show you guys this clip here and this diagram of what this is, but it talks about the different emotions that investors experience during different market cycles. And if you think about it, the market goes in cycles where it goes up dramatically, it kind of peaks, and then it goes back down. They call that cycle the peak-to-trough cycle, okay? And so people have very different emotions in a trough than they do a peak. And so I think going through, what we think of some of the emotions in this chart that people feel during this peak-to-trough cycle is very, very important. And kind of starting in the trough, a lot of times, so the trough would be like we've just been through a bear market and the market's been down for a while. People are pretty discouraged. And a lot of times, when the market, so say you've been in a trough for the last year, the market starts to go back up and people actually are experiencing at that point in time disbelief, right? They're like, the market's going up, but the market doesn't go up because in their mind, the stock market's not a good thing to invest in anymore at that point in time. And then, if it keeps going up, they eventually start to feel hope that like, hey, maybe this is a recovery. And then it keeps going up and then they go through optimism, right? And then they start to believe, they go through belief, then they go through thrill. And at the very, very top, they'll feel euphoria, which we actually experienced. And we were talking about this yesterday. We saw a lot of clients experience euphoria back in 2021, where we had people calling in saying, hey, I want to buy this meme stock, or I'm going to take out $20,000 and I'm going to invest it on my own because I know I can do better than what, my more diversified portfolio is going to do.
Absolutely. The .com was a really,
What's
the
that,
.com
Eric?
era was a really good definition of euphoria when people were putting money into pets.com and Ask Jeeves and all those companies that never produced a single dollar worth of revenue. That's a euphoria moment.
That's euphoria.
Sure.
Yeah. And then what happens is the market goes down some, and then investors are complacent because they think that, this is just a little temporary pullback and it's going to come back. And then as it starts to move down to trough, people then start to experience anxiety. And a lot of times the next is denial. They can't believe that their money has gone down. like it has, and then it's panic. And then finally it hits trough, and then people experience anger, right? So they're angry, and it goes on for a little bit, and then they're kind of depressed. And then that whole cycle starts back over, and they go through, the market starts to go back up. They feel disbelief, right? And so what we found is that there's really kind of three big emotional roller coaster items of investing. And you've got your fear and greed cycle, which we're kind of talking about there. And then you've got your recovery or your recency bias and your confirmation bias. Just to hit on those real quick. When you talk about fear and greed, it's exactly what we were talking about in 2021, right? Is people are greedy because the market's gone up and they think it's never going to go back down. So they're experiencing greed, and they're a lot of times making irrational decisions at that point in time. And then on the fear aspect of that, I think a great example could even be just right after that in 2022 is, interest rates have gone up, markets have gone down, and people are wanting to go to cash when the market's trading at 20% off of its most recent high, which typically, what Warren Buffett would say is that's the time to buy, not the time to sell. And then you've got your recency bias. The recency bias is where people really, take recent events and they weight them higher than they should be. I think my greatest example of that's going to be 2008, 2009. We had the big, great financial crisis. And I think for 3 to 4 years after that, people thought in their mind that the market just went down 50% on a regular basis and that it crashed all the time. The reality is it doesn't crash all the time. That was something that happened recently, and people thought that it happened more often than it actually does. And then your last one's going to be confirmation bias. And I think this is really prevalent right now, specifically with our political environment, is that people, they have a belief system, that maybe the market does good when Republicans are in, or it does good when Democrats are in. And whatever their belief is, they tend to think that the market's going to move based on what they believe it's going to do. And a lot of times those beliefs aren't right. So, I think some of the things that we've been talking about, if we're going to go through ways to avoid falling into some of these traps, I think the first thing we were talking about is just diversification.
Uh-huh. Yeah. Yeah. In our industry, our line of work, there are tons of, rule of thumbs or cardinal rules about investing. The main one that we talk about is buy low and sell high, which we'll talk about here in a little bit. But the biggest one that everyone teaches and preaches is diversification. And what does that mean? And how does it work? Diversifying your portfolio, you're spreading your risk across different asset classes. So rather than owning just Apple stock, you might own large cap indexes, mid cap indexes, small cap, international, emerging markets, bonds, treasuries. There's so many asset classes that we can put into these portfolios depending on your risk tolerance is kind of how aggressive you would invest. So what we typically say is, if we're going to own a well-diversified basket, we do want to have multiple asset classes in there. We just don't want to own the market or the S&P or whatever you say. We want to have exposure so that when the S&P is in a spiral or a decline, maybe international stocks and those bonds are appreciating while some stuff is going down. So you really can balance and weigh that portfolio a little bit better. Otherwise, if you own $1 million in Apple and Apple gets cut in half by bad earnings call, now you have $500,000. So that can be very detrimental to a portfolio. And that's when you kind of run into concentration risk. So diversification, it's an easy tool to kind of abide by. And that's something that we build our portfolios around, is diversifying our asset classes.
Absolutely. And the other thing that we really want to make sure that people think of is a long-term play. And we get asked all the time, if it's at a party or some other event, what's the market going to do? And, usually a good question in return to them is, well, give me a time frame. Because if you're talking 6 months, I don't know. It could go up, it could go down, it could be the exact same. But if you give me a longer time frame, say 5 years, 6 years, 10 years, then I'm definitely going to feel optimistic that the market's going to be higher than where it's at today. And I think you have to remember that the markets go up and they do go down. And we have periods of time, multiple times throughout the year where you're going to see a 3%, 5% drawdown in the overall market. That's going to happen multiple times a year. Once a year or once every, 13, 14 months or so on average, you're going to have a correction. and a correction is a 10% decline. That's going to happen. And then you're going to have about every, call it 3 to 4 years, you're going to have a 20% decline, or that might put you into a bear market. We're seeing that, or we've seen that with the individual stocks. Certain individual stocks have already had a 20% pull down or drawdown. And that's the one that's a little bit more meaningful, but obviously that doesn't happen every year. It happens every average 3 to 4 years or so. And then the big one is that kind of big reset where it's, 30, 40 plus percent drawdown. That's financial crisis, .com bubble, and so on. Those happen, more towards every 10 to 15 years or so is when you have a great reset. So just keep that long-term mentality, and you're going to usually have a much better returns. That's kind of the difference between investing and trading. If you're going to be investing, you're going to be in it for an investor for the long term. For trading, then you can worry about the next 6 months. But we're investors, and so we're in it for the long term.
Yep. I'll tell you one of our favorite charts too. We've shown it in a number of, LinkedIn posts as well as some presentations we've done. Is that, JP Morgan does their what's called Guide to the Markets, and they put that out every quarter. And they have a little, in kind of what you're talking about there, Eric. They have a chart that's called the intra-year declines versus calendar year returns. And in essence, what that is it's showing, in each given year. And I think, Ethan, you mentioned it yesterday that maybe it was 2020 that I think at one point in time during that year, that was the COVID year, the market was down 35% off of its most recent high, or as close to that, something like that. And then by the end of the year, it was up 16%. And if you go back to every year, usually even the years that are down, at some point in time, the market was down further than where it was at year end. And so I think that chart is such a great chart for helping people keep into perspective, when the markets go down, because many, many times it goes down, and it could even go down significantly during the year. And then it's still positive by the time the year is over, because it recovers and then goes on to even go higher.
Well, and you definitely want to stay invested too during those times, during those drawdown times. And that's something that, there's always numbers and stats out there. We got a ton of them. But if you miss the top 10 days, the 10 best days in a market, over the course of a year or 5 years or however long your time frame is, if you miss the top 10 days, your returns are cut in half. It's that easy. So that's why you stay invested even during the down times.
Yep. And we'll go into kind of some opportunistic rebalancing here in a minute. But before that, another thing, that can be very, very helpful is to use products that actually provide guide rails and what we would call downside protection. And to give a little bit of a background on this is when I first got into the business, I worked for a big insurance company that underwrit a ton of annuities that actually had what they called guaranteed income benefits at the time. Okay. Now, and there's still some of those out there, guaranteed withdrawal benefits and stuff like that. In essence, what it was is you would invest a certain amount of money, and then they would give you a rider on there that would allow it to grow at a certain rate. And then it would guarantee that you could take a certain amount of income off of that rider value down the road. And I tell you what we found out is a lot of times those products where the value of those things was not necessarily the rider, because the irony of it is very rarely did you have to use the rider, for people, because the market historically has gone up about 75% of the time, meaning usually the market outperforms the guarantee in many cases. And so, however, what we did find is that it helped clients feel a sense of safety when the markets went down, and it made them, it made them less likely to make a bad decision and sell out when the market's at an unfavorable spot. Well, today, a lot of those products have evolved a lot. Okay. Meaning there's things that we can place in people's advisory accounts. When I say advisory, just their investment accounts with us, that if they're willing to commit to a certain time period. So say we're going to buy a 3-year product. Well, we might be able to invest in something like the S&P 500 or the NASDAQ or the Russell 2000. And basically we can put guardrails on it and say, hey, we have a buffer of a certain percentage on the downside. So if 3 years from now, that index is down, we're buffered on the downside, and we're not going to take that full loss. And a lot of times you still get 100% of the upside of that. So there's certainly ways. And even if that protection doesn't come into play for that client, it provides safety, and it makes people just more comfortable I think investing and not making the wrong decisions at the wrong time. So
absolutely. Well, think about it. If someone needs to take a withdrawal or required minimum distribution or something like that, and they know they're going to start doing that 3 years from now, 5 years from now, and they're nervous and they want to make sure that it's there. I mean, what a great opportunity to sock some money into there. You know that it's going to have some of those protections around it, going to be available for you. It's going to grow if the market goes up. It's going to protect if the market goes down. And it'll be there for your distribution when you need it.
Speaking towards, I know Jeb mentioned it earlier, the opportunistic rebalancing. Again, back to those initial cardinal rules we talked about. Goal of investing, right, is to buy low and sell high.
According to Andy, he said you can just buy high and sell higher. That
right.
Works too.
You could do that as well. Yeah. I like that one. But being in the industry for as long as we have, we've kind of understood it's virtually impossible to time that market. If I knew when the high was going to be, we would sell. And if we knew when that low was going to be, we would back the truck up and deploy all that cash. But you just don't know when that's going to happen. So Eric, talk to us a little bit about opportunistic rebalancing, some of the mistakes that people make along the way, and kind of what rebalancing does to those portfolios.
Yeah, if you have a really solid diversified portfolio, you're going to have some of the investments aren't going to perform as bad, so to speak, when the market declines. A great example of that is a lot of fixed income during COVID 5 years ago. Where we're sitting right now, which is 5 years ago, you had a lot of fixed income that was possibly not even down, but possibly even up, as increased in value during the COVID, during that big COVID drop. What opportunistic rebalancing is basically taking a portion or rebalancing your portfolios, selling some of those that have not gone down as much or possibly even increased in value, and reallocating or redeploying that money into an investment that has gone down with the rest of the market. The idea is eventually, as we just already talked about, the market does recover. It's got 100% recovery rate. From every bear market, it has recovered 100% to all-time highs. This is the opportunity to sell some of those that have not down as much, or possibly even up, into more of the aggressive portion of your portfolio to ride the recovery a lot faster on the way up.
Definitely. Yeah. And rebalancing helps with eliminating that focus that people have on trying to time that market. So when you do rebalance, it's not like we just kind of on a whim say, oh, we're going to rebalance today. We kind of look at, do we do systematic rebalances, right, quarterly rebalances, monthly rebalances? You can also rebalance probably too much to some extent as well. So there's a method to the madness, and just know that rebalancing is a tool that we use in times of volatility to just help climb out of that hole on the other side of things.
The market is the only place that you could literally love something at $100 a share, and then a few months later it's $70 a share, and you absolutely hate it. It's the only place on earth. Everywhere else you're like, I'm pretty excited. I just bought a car for 30% less, or a house for 30% less. But the market is the place that everybody hates that. Doing that strategic rebalance, having your plan, doing your monthly or biweekly paycheck contribution to your retirement plans, that helps eliminate some of that volatility and gives you opportunity to do what we want, and that's buy low and sell high.
I would say too, what you're saying there, everyone wants the stock when it's $100, but they don't want it when it's $70. And that kind of comes back to the beginning of the podcast where we're talking about fear and greed. When you're at $100, everybody's greedy. And when it's at 70, everyone's fearful. But if you can kind of reverse that thought process, a lot of times that can create a lot of success in investing over time. So, guys, this has been very good. Just to kind of summarize, is that as we're talking about psychology of investing, the key to investing long term is to stay invested, to stay disciplined, and not to let your emotions get the best of you. And that historically, obviously, we can never guarantee what's going to happen in the future. However, markets do have a 100% recovery rate. We were joking earlier. We say, they always say the Grim Reaper is undefeated, right? Everybody dies someday. Well, historically, the market's undefeated as well. It's always come back. Now, we can't guarantee that in the future, but I think if you're playing the odds and you believe in the stock market, that's a good thing to think about when the market's down. And then, like Ethan was talking about, diversification. You got to have a diversified portfolio because that's what allows for that opportunistic rebalance in times when the market's down. And it also just over time helps you be invested in a lot of different things. So this has been a great time, guys. Thank you for all of us joining today. And this is Metcalf Money Moment signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.